There have been many strange events in financial history, but perhaps the strangest of them all was the day that oil prices went negative and the whole oil market was turned upside down. On April 20th, 2020, the price of U.S. West Texas Intermediate crude oil crashed nearly 300% in a single day and closed at negative $37 a barrel. You heard that right. The price of an oil barrel was negative $37. You might be wondering what negative prices even mean. After all, it's not something you would ever see on a price tag in a store. Well, negative oil prices meant that anyone who wanted to sell a barrel of oil would actually have to pay the buyer $37 in order to get them to take the barrel of oil. So not only could buyers get oil barrels for free, but they were actually getting paid to take the oil from the seller. In other words, oil demand was so low that people were literally paying other people in order to get rid of their oil barrels. This complete collapse of the oil market in a single day was absolutely unprecedented, and it's something that most people would have never even considered as being possible. After all, the global economy is powered by oil and energy. It's estimated as of 2022 that in the United States alone there's an average of 20.28 million barrels of oil used per day. Oil is also the largest consumed energy source in the United States, making up 36% of the country's energy mix. And that reliance on oil is even more glaring in transportation, where petroleum products make up 88% of the U.S. transportation energy mix as of 2021. But as everyone knows, things in 2020 were different, to say the least, and the oil market was no exception. The COVID-19 pandemic led to economic chaos, as entire countries instituted quarantines during early 2020. As people were living at home, this significantly changed energy usage patterns, which would majorly impact the oil market. While people were still using energy in their homes, oil consumption for transportation slowed down to a trickle nearly overnight. The transportation market, which is 88% reliant on oil, had its demand evaporate, and this created massive shockwaves that reverberated throughout the oil market and the entire economy. These economic shockwaves from COVID-19 were the backdrop that would set the stage for oil's collapse into negative prices. But in order to really understand how oil collapsed to negative $37 a barrel, it's also important to know the basics of how the commodities market works. For those who are unfamiliar with commodities, think of them as raw resources and basic goods. Things like copper, lumber, wheat, iron, and oil. These are raw goods that are essentially interchangeable with goods of the same type. In other words, when you buy a commodity like oil, it's going to be basically the same no matter where or who you buy it from. Since these goods are interchangeable and pretty standardized, these raw resources can be sold on the open market fairly easily, at whatever the current market prices are for those resources. Now, the commodities market involves the trading of a type of derivative called futures contracts. A futures contract is essentially a contract between a buyer and seller, where the seller is agreeing to sell a fixed amount of their commodity to the buyer for a fixed price on a set date in the future, hence the name futures contract. These commodities contracts are traded on organized exchanges known as futures exchanges, and the futures contracts are standardized by the exchanges to make them consistent and easily tradable. For example, a crude oil futures contract could specify the delivery of 1,000 barrels of crude oil at a price of $50 a barrel to be delivered on the third Friday of July. Now, it's really important to know that when a futures contract is created, the buyer and seller are both locked into the agreement, and the buyer now has an obligation to buy that commodity from the seller on the set date and price, and the seller is obligated to then deliver the commodity on that date. This is very different from the way stock options work, where the option owner has the right, but not the obligation to exercise the options contract. In a futures contract, on the other hand, both parties are legally obligated and required to actually execute the transactions specified by the futures contract. The only way either party can actually get out of the futures contract agreement is if they close their position by buying or selling an equal and opposite futures contract on the open market. By closing out the futures position this way, it effectively means someone else in the commodities market has now assumed the position of needing to meet the requirements of that contract. In other words, some other party has agreed to replace your role in the contract. So you might be wondering, why go to all this trouble to trade futures contracts? Well, these futures contracts are useful for a couple reasons. The biggest one is that it lets commodity suppliers hedge themselves and mitigate their risk as a company. For example, if an oil producer were to enter into a futures contract to sell 1,000 barrels of their oil supply at $50 a barrel a month from now, they would now have a guaranteed buyer for their supply of oil, regardless of what happens to the price of oil a month from now. So if in 1 month the price of oil goes up to $60 a barrel, they are still contractually obligated to sell those 1,000 barrels at $50 a barrel because of their futures contract, which means they will miss out on some extra money they could have made selling their supply on the open market at the current rate. But on the other hand, if the price of oil were to go down to $30 a barrel, the oil supplier can rest easy knowing that they have a buyer for their 1,000 barrels of oil at $50 a piece. So even if the price of oil were to crash, the futures contract allows them to lock in a future price to hedge and protect themselves from price movements in their product. The other main party in the commodities market are speculators. And speculators, unlike producers, are aiming to profit from price fluctuations in the commodity by taking on risk, and they don't really have any direct interest in the physical commodity itself. For example, if a speculator buys an oil futures contract for 1,000 barrels of oil at a price of $50 per barrel, and the price of oil quickly runs up from $50 to $60, they can now sell that futures contract on the commodities market for a nice profit, since the contract has favorable buying terms compared to the current market price of oil. It's important to know that most speculators have no intention of actually holding the futures contract to the delivery date and being responsible for buying or selling the physical oil. So these speculators will always be sure to exit their futures contracts by finding someone else to take their futures position before the contract's delivery date actually arrives. And most of the time, these speculators are able to exit their contracts for crude oil pretty easily. But on April 20th, 2020, things were different. Oil, like most things in the economy, is governed by supply and demand. As supply and demand change, the price of oil will change accordingly until it finds its new equilibrium point. And in 2020, during the early parts of the pandemic, oil had everything going against it. As entire countries shut down, oil demand cratered in a way that had never been seen before. It's estimated that oil demand fell nearly 30% by April of 2020, as transportation slowed to a crawl and hit oil prices hard. But to make matters even worse for oil prices, supply was extremely high, as the Organization of Petroleum Exporting Countries, better known as OPEC, failed to reach an agreement on oil supply cuts, which led to a price war between Russia and Saudi Arabia, which flooded the market with millions of extra barrels of oil per day. With oil producers flooding the market with tons of excess supply into a historically low demand environment, oil prices were falling fast. But on April 20th, 2020, the entire oil market finally cracked. The thing about millions of barrels of oil is that they take up a ton of storage space. And with high supply and extremely low demand, the oil industry was actually starting to run out of convenient storage space for oil. Cushing, Oklahoma in the United States is one of the main hubs in global oil trade and is a main storage location for U.S. oil with approximately 76 million barrels of storage capacity. It's also the location where all the barrels of oil being bought and sold through futures contracts for West Texas Intermediate crude oil, better known as WTI, actually get delivered. So all futures contracts for WTI crude oil get delivered to Cushing. And normally the 76 million barrels of storage capacity is plenty of storage for Cushing to handle the delivery and settlement of futures contracts. But in April of 2020, Cushing already had about 70% of its storage capacity filled, and the remaining storage was filling fast. And the pipelines transporting oil out of Cushing were already working at max capacity already. So as the delivery date for the April futures contracts of WTI crude oil drew near, commodities traders were scrambling because there was a shortage of available storage and they had nowhere to put the oil. Many of these commodities traders had no intention of actually physically buying or selling thousands of barrels worth of oil in the first place, since they were incapable of storing it. So they scrambled to get out of the futures contracts through any means necessary. The rush for the exits on these contracts began a massive sell-off in the April WTI crude oil futures contracts, which crashed into negative pricing territory as traders were forced to pay other people to take the responsibility of receiving the physical delivery of the thousands of barrels of oil on delivery day. Normally, traders can exit these futures contracts at a positive price, since oil is valuable and people generally want and need oil for lots of things. But the oversupply and storage problem was so dire on that particular day in April that oil actually had negative value on the open market, as nobody wanted to take delivery. Because of this, the futures contracts closed around negative $37 per barrel for the April contracts that day. And since oil futures trade in 1,000 barrels for each contract, this means that some of these traders ended up paying people $37,000 per contract to take the oil off their hands. Losses would have also been far greater than just $37,000, as almost all of these traders had paid significant money to buy these contracts in the first place. So it's not like they just lost their entire investment in the futures contract. They lost their entire investment and then had to actually pay an extra $37,000 per contract for someone else to take the oil off of their hands and deal with the storage problem themselves. The storage problem was so bad that for a while people were actually commissioning oil tankers to store massive amounts of oil barrels offshore as a sort of floating storage because the land storage situation was just that bad. Luckily, the market began to normalize in the aftermath of oil's plunge into negative prices, as oil quickly returned to positive territory soon after. In response to the chaos, oil producers were forced to slash their production to try to stabilize the price of oil. In addition, oil demand in the United States would bottom in April as well. So as producers cut back on supply and oil demand began to gradually recover, oil prices were able to stabilize and gradually return to normal. Negative oil prices in 2020 were an extraordinarily strange market event, and one that may never even be seen again. The phenomenon was driven by a very unique set of circumstances surrounding the COVID-19 pandemic, oversupply, and storage limitations. Although negative oil prices were certainly an anomaly, they are still a very valuable reminder that crazy things can and do occur in the market when supply and demand imbalances are combined with unexpected black swan events. But be sure to let me know your thoughts on negative oil prices in the comments below, and make sure to subscribe to the channel for more finance content. Thanks.